What if you took an income annuity in order to delay Social Security? Interesting, huh? So you're going to use a SPIA, a single premium immediate or income annuity. You're going to take a portion of your portfolio, throw it into an income annuity, and that way it provides you a bridge of income while you're allowing Social Security to grow with those 8% earnings credits, delayed earnings credits. I've had this question come up in my feed a couple of times in the last week or so, and it's one I haven't tackled much lately. Actually, I'm not even sure at all. I'm a huge fan of income annuities, don't get me wrong. But I used to tackle this quite a bit back in my working career over at USAA, and before that even. I say, look, if we defer Social Security, that's an 8% year over year plus a cost of living adjustment is guaranteed by the federal government and is taxed much more favorably than anything else out there. Is it more beneficial to do that? I don't know. So let's dive into it. There was it New York Life, I think. Maybe one of these days I'll revisit this paper they did. It's from an insurance company, so you got to take anything with a grain of salt because they get paid on selling annuities. But they did I thought a pretty good scenario where they're looking at an income annuity, similar to what we're talking about here, and what the effect of the overall net worth was. And there's a couple of issues on that, and I'll share with you here. But it's an interesting scenario nonetheless. So let's dive into this. So what we're going to do is we got Mike and Michelle, California. All right. So Mike and Michelle, they got essentially what's happening here. They have a total net worth of about $1 million, 1.077 million, which consists of Mike's 401k at 607,000, and they got a joint home. That's it. Now, Mike's 401k is actually $1 million, all right, but he's going to take 390,000 of that, and he's thinking about it and locking it into a 10-year period certain income annuity. All right, so that 10-year period certain income annuity is going to pay him. I got to use my Casty here, Splinty here, is going to pay him. Let's see, how much was it? The annuity is going to pay him $44,000 a year for 10 years. All right, so he's going to take $390,000 and he's going to get $44,000 a year for 10 years, so $440,000 out of it. That's the thought process. And in the interim, he's going to allow his Social Security to grow with the 8% delayed earnings credits. All right. So now Mike is, what do we say he is? He's 60 years old and he's going to retire right now. That's what he's going to do. He's going to retire. Michelle is 54. She's going to retire as well. Mike's income, if we go over here to income from Social Security, is his PIA is $2,800, which means if he takes that 70, it's going to give him about $3,700, a little bit less than about $3,687 if memory serves, but a little bit less than $3,700 a month. Now, Michelle's PIA is $1,585, but they're under the assumption that she'll take it at 62 and either get half of Mike's PIA will be reduced or half of her own benefit will be reduced. So that's what we're kind of contending with here, is that she'll get the greater of half of this reduced. It won't be insignificant. It'll be $800-900 a month roughly, but still, it's not going to be a huge amount of money. So we're not going to get too tied up in Michelle's, but be it as it may, she's not going to get much relative to Social Security, less than $1,000 a month, because she's going to take it at 62, which is a good move. And again, they're both going to stop working right now, so they don't have any other income coming in. So they need. So let's go to, and I'm not doing anything reverse mortgage or 401k. I'm not doing any of that. Just taking the income annuity, and that will stop at the end of year 29. So let's stop in 10 years, 10-year period certain, which means a 10-year period certain means it doesn't matter. If you die in the first day, your estate is still going to get paid for 10 years. If you die 10 years in one day, it stops. It stops after 10 years. If you live for another 50 years, it stops after 10 years. So be careful of these 10-year period certain ones or 20-year period certain. You got to be careful of that. But in this scenario, I thought it'd be interesting. And actually, this is from a guy who emailed me, so it'd be interesting to see. So that annuity is going to pay $44,050 a year on $390,000. So what we do is we take our 44, divide that by 390, and the payout rate is 11.28%. But again, that's not much. I mean, because most of that's return of principal. In fact, if we take our 390, right? We take 390 is our present value, and we have 440 total in payment in the future over 10 years. That's going to give us a rate of return about 1.2%. So we're not making much money there. So the vast majority of the income we're getting off the annuity is our return of principal. Yeah, so right there, I said, not so sure I'd do this. But anyway, let's dive into this anyway. We'll see. I think there might be a better way. Now I'm thinking about it because the interest rates are so low in these things. So I move this guy up. All right. So with me so far. So he needs $44,000 a year. That's his expenses. We go to goals. His expenses are $3,000 a month retirement living expenses. They have no debt. $8,000 a year in healthcare cost. Not worried about long-term care. So they don't have a huge expenditure, but they need enough to cover these costs right here, which are going to come from the annuity. And then as they hit 70, it'll come from the Social Security and his required minimum distribution. So let's take a look. I don't know what it's going to look like. I got my tree. Yeah, sweet. So what we're going to see here is we're going to see they're never going to run out of money. They're going to leave 4.016 at death, 4.016 million of liquid net worth. When Mike, I guess in this case Michelle dies because she'll survive Mike by a couple of years. We got a confidence level, so it's never running out of money at all. They're going to leave a significant estate. Let's see cash flows here. There's our income inflows, 44,000. Here's our expenditures though, 48,000. So they need to make up about six. Yeah, right here, net flows. We need to make up that difference from pulling distributions out of the IRA or Mike's 401k because we got to cover the taxes. And then once Social Security kicks in right here at 70 for Mike, look at that. Then they got a big tax payment because they still have the annuity, still have required distributions and Social Security to be kicking in. And then they have, total net flows. All right, so you can see the total net flows are going to go back into their not the retirement accounts, but their after-tax accounts. So I just want to see what the overall effect on net worth is. And what we're going to do is we're going to pause this. I want to see what the tax code looks like too. So anyway, let's go back to this. So they got 44,000. The single premium income annuity is not adjusted for inflation. I'm not a big fan of doing those for inflation, especially in this regard, simply because it's not. It's just the amount you get on the front end is so small. So don't do that. So then they hit 70. Mike will start taking Social Security. We'll go to income flows, see what we got. And there's Social Security, 68. That's going to be, that's when Michelle's taking hers. So she's going to get her, not a minimal benefit, but it's not a huge amount. But hey, we'll take it. That's what, $1,400 a month or something like that. And then Mike gets his. All right. So you got this annuity. It stops at 10 years. All right. So we got Social Security for both Michelle and Mike. They got the annuity will stop there. And then we also have the planned distributions from the 401k automatic RMDs, required distributions of 37,000. All right, so let's take a look at accounts here. So we're going to look at accounts, and we're going to look at right here. All right, so as you can see, we got the 401k. I'm going to do by withdrawals, and we're pulling a little bit of money out of the 401k. Initially, they have a savings account. I probably should delete that, but it doesn't matter. Literally, in this case, it won't matter. They're having 401k. They're pulling money out because they got to pay the taxes, and they need a little bit extra than what the annuity is going to provide. And then that stops. And so now they have so then their taxable account, they're not pulling anything out anymore because at age 70, their Social Security plus the RMDs are going to be more than enough for them to live on for sure. In fact, let's just go to expenses because their expenses here are 48, 49, 51, 52. You can see it's just going each and every year, but their total income flows are right here, 115, 119 because of Social Security and the required distribution. So that's interesting to me. So they've never run out of money. All right, so that's just a fact. So their accounts at the end of the day, let's just go to ending balances. When they both die, they'll have 1.138 million in a 401k, 1.138 401k with 4.4 million taxable account. All right, cool. So they're going to have 4.4 million in taxable account and 5.59 is a liquid net worth. All right, so let's do this. Let me pause. I want to do a tax cash flow thing, and I'll be right back. They paid 1.01 million in taxes over the course of their lives here. All right, so at the end of the day, they're leaving a a liquid net worth of about $4 million when all said and done. So that's, they're leaving a pretty good amount of money for sure, but they're also paying about $1 million in taxes too. So they're definitely leading some taxable accounts there to their heirs. Just want to go back to accounts. 5.529. Yeah, what did I get? The 4 point. Oh, that's right. So 5 point. Yeah, there it is. So 5.529 is the liquid net worth. The median, and we'll go back to retirement. The median net worth is, we go to analysis, is right here at 4.06. That's a median. So 50% of the time is above that. 50% of the time is below that. All right, so that looks good. I just wonder. What we'll do now is we'll get rid of the annuity profile. We're going to go to income. We're going to get rid of this annuity, all right? And we're going to go add that money back to Mike's 401k. We got to go to net worth right here. So he's going to have $1 million in there total. And again, we just have it in the S&P 500, nothing fancy. And so we're going to say we need $1 million in there. So we need, what, 4,000 shares or so? Oops, 4,000. Is that what we need? And that's the S&P 500 index, by the way. Maybe a little bit less than that. I'll say 3750. 37. Let's see what that looks like. There we go. Perfect. All right. So we got basically $1 million in the S&P 500. We got no annuity, and everything else is the same. Social Security at 70, and just pulling from the portfolio instead. Let's see what it looks like. You ready? You ready? All right. So now we're gonna have a liquid net worth about the median is 4.5 million. Okay, that's interesting to me. We're gonna go to what the accounts are. Let's see. We're gonna go to cash flows. See what the accounts are looking at, and we're gonna have in a 401. We're 5.14 million in a taxable account. And what's that? 1.443 million in Mike's 401k. So now let's see what they paid in taxes. You ready? So we're going to go to this guy here. I wish they just keep a running tally. I don't know why they don't have just a running tally on taxes. It'd be so easy just to develop that, but no one listens to old Josh. All right. So we're going to see here. Oops, I hate when it does that. Bear with me just a second, my friends. We're going to get rid of that guy. Oops. Let's go back here. Cracked the, yeah. All right, there we go. Blink. Probably should pause it so you don't have to see me do all this, but there you go. All right. All right, so now we're going to go to taxes here. I have no clue which one's going to be worse. We're going to sum them up, and they're going to pay 1.27, so $200,000 more in tax this way. But they're going to have, they're going to have over $1 million more in net worth. 6.5 in total net worth. I don't see how the annuity is going to be beneficial there. I just pull it from the 401k. And if I may, just remind you, I'm not swinging for the fences on the money here. I'm saying it's a 7.4% annual rate of return. Going from now into eternity, essentially. So I'm not sitting there thinking Dave Ramsey 12%. We're only using 7.4%. What if we, now what we could do is we could start doing Roth conversions. Let's do this. We're going to go to profile, and I already got it in here. Let's see. We're going to do Roth conversions of, let's do Mike's distribution. Mike. We're going to do Mike. Yeah, there we go. And we're going to say, I don't know, $50,000 a year. That's only be $500,000 bucks. Let's do $100,000 a year just to see what happens. We're starting 2020. I'm just curious to see what 100, maybe 75, because he's going to be taking money out of the 401. Well, let's just do 100,000. Let's just see how this shakes out. Now let's do 75,000. Let's see how this shakes out. 75,000, because he is going to be pulling roughly 50,000 a year out of the 401k anyway. We got that. So remember, if you're doing Roth conversions, make sure that button is checked that says convert to Roth. All right, so let's see what this looks like now. So nothing else has changed. We're just doing Roth conversions now. All right, so let's take a look. With Roth conversions, what we're looking at here, 4.6 million. Look at that, man. That's crazy. 4.6 million in median net worth. All right. We got cash flows. Let's see what the accounts look like here. And the accounts are all in Roth. And look at that, 6.9. Freaking Bill Roth, will you marry me? Look at this, my friends. 6.5 million in Roth IRA, 358,000 in taxable account. That's we'll just say that's 7 million bucks. That's rough. That's a little bit more than what he would have done the last account we did. So before we started with doing the annuity, so I'm scratching that. I just don't see a benefit of that at all. We're going now to a Roth IRA plan, which is basically. Then we went to where he didn't do the annuity, just pulled the money from his 401k whenever he needed it. That left him about a little bit shy of $7 million in liquid net worth, right about 6.9. But of that liquid net worth, 1.443 million was still in his 401k, which means it can be taxable to his heirs. In this stage, though, he's got about 6.9 million in liquid net worth. None of it's taxable to anybody. It's all tax free. It's so. I'm just curious. Let's see what this guy looks like here. Oh, does that not make you just you want to bow down and say, "Dear Lord, thank you for giving the human brain the capacity to live in the United States and look at a tax code where we pay nothing." Why do you think we got that little bit of tax there? If you said the widow's tax trap, you are right. That's just a sight for sore eyes. So let's go to taxes here. Oh, I love it. What do? I want to go to. I want to do taxes, and we're going to go to show you how much less in taxes he pays. This is going to be freaking nuts. Oh, look at that. Oh, I love the tax code. It's the best thing ever. All right, so let's see what we got here, and we're going to come down. Oh, this is fantastic. $274,000 in taxes. You increase your net worth by $200,000 just at your death, and you reduce your taxes by $1 million, and you're increasing your net worth by well into the six figures to your heirs, because what they're gonna inherit, they're gonna inherit all tax free. Whereas before they were not inheriting that tax free; they were inheriting completely taxable. For the most part, they would have inherited this tax free, but they still inherited the IRA 401k taxable. So they lost another $250,000 to $350,000. All right, so let's do something here. I'll wrap this up. So we're going to go back. We're going to get rid of the Roth conversions. And we're just going to say, let's just do this blank. We're going to say 0. And I want to show you what the tax graph looks like going back to this guy here. All right, so you saw, remember at 7, there's no more taxes. Look at that. That's the difference, man. So now Miss Michelle is going to be hammered from a tax perspective, because this is the widow's tax trap in its full force. So essentially the question is, does Mike and Michelle want to pay a little bit less tax? I mean, let's look here now. We're going to go to cash flows, taxes. So they're going to pay $4,000, $4,000, $4,000. Not much in taxes the first front of the retirement, but then it's going to gradually get more and more and more until it'll be in the six figures when Mike dies. Do they want this, or do they want the other way, which was basically, let's go back again. We want to go to income. We want to do 75,000. And remember, you all have access to doing all this stuff if you have the software. I mean, you can do all this. Let's go to taxes again. So here, or this right here, where they pay 15 to 20% on the front end, but nothing on the back. And if we go to, so remember, they're paying like $4,000 in the first few years of retirement until RMD's kicked in. And here they're paying, $27,000, $27,000. The most they ever pay is less than $31,000, and they never get anywhere near six figures. It seems to me a slam dunk. That's in my opinion not even debatable. I can't see them doing the annuity. Not with this. I mean, $390,000 on $440,000 on a $390,000 investment over 10 years. I just don't see the benefit of that at all. I do see the benefit of the Roth. Hope this helps. Woo! Subscribe, smash, and thank Bill Roth. And believe it or not, Tom DeLay. All right, we had the Bill Archers, Bill Roth and Bill Archer. The Archer savings account, Coverdale savings accounts. Tom DeLay got those through when he was House Majority Leader, if memory serves, and Bill Roth got through on the Senate. So thank those guys, because this is a big deal. All right, we'll see you next time.